Welcome to Stock Spotlight. I'm Michael, your guide to the stock market. In each episode, we analyze companies that have earned a watch or pass rating on my initial research checklist. Today, we're shining the spotlight on Tyler Technologies, ticker symbol TYL, and uncovering what makes it a potential new investment opportunity. Join me as we explore the insights and strategies that empower savvy investors like you to make informed decisions. Let's dive in. My 33-question checklist evaluates companies across 9 categories, which helps me gain a holistic understanding of the business. To date, we have screened 233 companies across 9 sectors and 70 industries, with a mean quality score of 61% and a top quartile benchmark of 70%. For Tyler Technologies, I screened them in June 25, and data used for this episode is as of Q2 25. They scored a 53% quality score, which was in the 33rd percentile overall and the 18th for their sector. The status for that is a watch. I wanted to also call out that Guru Focus gives them a 94, which is much higher. They're 76th percentile overall and 60th in the sector. And sentiment on X is often positive, so I wanted to do a deep dive on this company. First, let's discuss Tyler's business. As of 9/23/25, they are a $23 billion market cap, which is a large cap. And according to the GCIS classification system, they are a software system and application industry company within the larger information technology sector. Tyler Technologies traces its origins way back to 1966 when it was founded as Saturn Industries, a diversified industrial holding company. After shedding its industrial operations and acquiring early government-focused software providers, the company rebranded in 1997 as Tyler Technologies Incorporated, marking its transition into a pure-play technology provider. In their May 25 investor presentation, management broke down Tyler's history into 3 eras: 1998 to 2017, building leadership position, which includes expanding its portfolio to cover ERP, courts, tax, and public safety software; 2018 to 2022, expanding the vision, which includes making strategic investments in connected communities and moving to a cloud-first model; 2023 to present, sustained growth and free cash flow generation. Here it's about reaching a SaaS inflection point with accelerating recurring revenue and free cash flow focus. I have Tyler firmly in the mature growth stage. I believe they're an established market leader in public sector software, generating $2.1 billion in 2024 revenue with 85% recurring, 98% retention, and a clear focus on efficient compounding. In terms of what they sell, you can think of Tyler as the operating system of government. They provide mission-critical software that keeps cities, counties, schools, and states running. Their product suite spans 5 major solutions, including public administration, which is HR, tax billing, permitting. They also have courts and public safety, which the main thing here is their Odyssey case management. Third, they have schools K-12, which includes payroll, budgeting, and procurement. They also provide health and human services, which includes environmental health inspections. And lastly, platform and transformative technology, which includes digital government portals and outdoor recreation reservation systems. They are a B2B company, and 95% of their revenue goes to state and local government markets, with the other going to federal. Their clients range from major metros like Los Angeles County to tiny Loving County, Texas. They definitely provide an essential service. These systems run tax collection, payroll, court filings, utility billing, emergency response, and digital citizen services. Government simply cannot operate efficiently without them. And one of the nice things about Tyler is that they do not carry customer concentration risk, as they are a highly diversified business with 45,000 plus installations across 13,000 client sites. And they definitely have one of the broadest, stickiest customer bases in enterprise software. Now turning to their business model, I'm adding a new section for their CFRA risk profile. And for Tyler, CFRA assigns them a medium risk. They note that public sector funding is generally resilient and non-discretionary, with secular IT modernization providing a strong tailwind. However, they do note that risks include intense competition for contracts, long procurement and evaluation timelines, and delays tied to budget cycles or policy shifts. Now, Tyler generates revenue from three primary sources. The first and perhaps most important is subscription-based services. These are SaaS arrangements and transaction-based fees. This source generated $1.3 billion in 2024 revenue, which was 63% of total revenue and up from 59% in 2023. It was the largest growth driver with double-digit revenue growth every year since 2013 on stock analysis. There's also maintenance and support contracts, which is phone or internet support through help desks that are staffed by client support representatives. This source generated $463 million in 2024 revenue, which was 22% of total, and they've actually had negative revenue growth the last 3 years. Nearly all on-premise clients purchase annual or multi-year maintenance contracts that auto-renew, so this is a nice source of recurring revenue. And lastly, they have a professional services bucket, which is simply the installation, training, and data conversion services. This source generated $264 million in 2024 revenue, which was 12% of total, and has had mostly positive revenue growth the last decade, outside of 2020 and 2023 to 24. In total, 85% of revenue is recurring, and ARR grew about 20% the last 5 years. Tyler's revenue stream differs by contract type. They have a payments section of the business, which you can think of as the NIC acquisition and also Tyler Payments. 93% of these contracts are what they consider gross, where Tyler records the full transaction value, pays out an interchange and merchant fees, and then retains the spread plus a fee. This way of accounting inflates revenue and free cash flow, but does pressure margins, versus net contracts where Tyler only books a fee. Speaking of net contracts, they also have a subscription contract type, and this is recognized ratably over the contract term, which is typically 1 to 3 years, but occasionally up to 10. Now, they are actually reported on a net basis, and only Tyler's fee is recorded. Management notes that the mix shift towards SaaS and recurring subscriptions should lift margins over time, even though it may understate top-line growth versus the gross payments method. Some key revenue drivers to pay attention to for Tyler is their SaaS migration. Around 90% of new deployments are cloud-based, but a large installed base remains on-premise, which does create a potential long runway for migration. Also, transaction volumes. As adoption expands, payments and digital government services grow. There is some seasonality tied to Q2 outdoor recreation and statutory filing peaks to be aware of here. And then the last one to pay attention to is cross-selling. Tyler's investor deck actually mentions that they have an average of 3 products per customer with a potential of 8 to 10. So here they can leverage that broad suite and perhaps the 2021 NIC acquisition to deepen penetration in existing accounts. Which then gets us to looking at pricing power and the sales cost. I have them as moderate pricing power. As previously noted, their software is mission critical, but governments are price sensitive. And as CFRA notes, bids are competitive. But one thing I like about all of the competitors in this industry is that their solutions typically represent a small fraction of a government's total operating budget, but are essential to core functions. Turning our attention to any business segments and geographies to pay attention to, they effectively have a 2-segment US-dominated business, with international expansion more opportunistic than core to the model. Their 2 segments are enterprise software and platform technologies. They say that enterprise software provides mission-critical back-office systems for public sector entities, including public administration, courts, public safety, education, and property recording solutions. These are the traditional ERP style and case management offerings that have been Tyler's backbone for decades. And in fiscal 24, they generated around 71% of the total revenue at $1.5 billion and most of the operating income. There's then also platform technologies, which is 29% of total revenue, or around $619 million in 2024. And these are those transformative or digital first solutions. And it includes digital government portals, payments, transaction processing. And the segment actually has grown significantly since the NIC acquisition in 2021. In terms of geographies, Tyler is a US-centric business. And while it does note that they have clients in, I think, Canada, the Caribbean, and the UK and Australia, the international resorts are not broken out in the recent 10K. We do have a Morningstar moat rating for Tyler, and they give them a wide moat, which is anchored by high switching costs. They note that governments rarely change vendors given the risk, cost, and disruption involved in replacing those mission-critical systems. Now, every great company reinvests in itself, but not all R&D spending is created equal. I break it down into three key areas: how much they spend in absolute dollars compared to peers, R&D as a percentage of revenue, and how efficiently they turn that R&D into growth. I compared Tyler to two different publicly traded companies, Oracle and Workday. I did want to add i3 verticals, but they actually don't formally break out R&D. On an absolute dollar basis, Oracle is way above everyone else at around $10 billion trailing 12 month. Workday follows at around $2.6 billion, and Tyler is very small at $158 million. Morningstar does note that Tyler categorizes some portion of R&D within COGS, so we might be underinflating Tyler just a little bit. And then on a relative basis, Workday is far ahead actually at 30% of revenue trailing 12 month versus Oracle at 17% and Tyler at 7%. What's interesting is that when you actually look at my efficiency ratio, which I'll be tweeting about this, so look to X for that post, but Tyler is actually the most efficient at converting R&D into growth with a trailing 12-month efficiency ratio of 1.82 compared to Workday's 0.67 and Oracle's 0.53. A strong company is only part of the equation. You also need a great industry. So let's take a closer look at the landscape Tyler operates in, which they call the public sector software market. In terms of industry attractiveness, I give this an overall attractive rating, as I believe secular tailwinds around cloud shift, the digital monetization demand, and high barriers to entry with low threat of substitutes outweighs the moderate to high competitive intensity and moderate buying power. Looking at the industry size and growth forecast, the current size is around a $21 billion TAM as of Tyler's latest investor deck, and Morningstar also cites around an $18 billion TAM, with federal expansion pushing total TAM to $30 billion plus. In terms of market share, Tyler's latest investor deck implies around a 6% share or $1.3 billion in ARR share versus TAM. In terms of systems penetration, Tyler has around 44,000 installations across 450,000 local government systems in the US, implying about a 10% penetration today. Analysts using investorsgrow.com project Tyler's revenue to grow at around 10% CAGR through 2027, which does outpace the broader public sector software market's 4 to 6% annual growth stated in Tyler's latest investor deck. This suggests that Tyler is steadily expanding market share, with significant runway remaining as around 90% of systems still run on legacy or homegrown applications. Looking at the competitive environment, I'd describe it as competitive and fragmented. There are three broad competitor types. The first is large ERP players like Oracle, SAP, ServiceNow, and Workday. These global giants offer broad enterprise systems and increasingly sell into the public sector space. Their strengths are scale and cross-industry reach, but their government offerings are often adaptations of horizontal ERP platforms, making them less tailored to the public sector compliance and workflow. Tyler notes that around a third of competitive deployments are these players. The second bucket is vertical public sector specialists, which includes Constellation Software and i3 verticals. These firms specialize in vertical or mission-critical software. Constellation, in particular, is a major force, as it's over 3 times the size of Tyler and is scaled slightly differently by acquiring hundreds of niche software businesses and really leaving them alone versus Tyler's integrated, cohesive approach. i3 Verticals is smaller, but focuses on similar vertical SaaS and payment system solutions for utilities, municipalities, and public schools. Tyler also faces solid competition from private players like Central Square and D4H in emergency services software. While ERP giants overshadow Tyler in size and vertical peers nibble at the niches, Tyler's deep public sector specialization and integration of payments plus SaaS give it a unique edge in the marketplace. Uncomparably, Tyler trails peers in both customer loyalty and NPS. Its 61% loyalty score is well below the peer median of 71%, lagging leaders like SAP at 81% and Workday at 80%. And the gap is even more pronounced on NPS, where Tyler has a negative 38, which is far under the median of 31, and behind all major peers, including Constellation Software at plus 48. I also like to do a financial metrics comparison using fiscal.ai, and I use the peer group i3 Verticals, Constellation Software, Oracle, SAP, and Workday. Look to X for the full tweet, but Tyler's gross margin was second lowest only to Constellation, while its free cash flow margin came in a solid third. Its 15% revenue CAGR stands out versus most of the large cap peers, though it does trail Constellation Software's exceptional 23.8% and Workday's 17.5% revenue CAGR. ROIC is fairly low for all companies here, with Oracle actually standing out at 12% on a 5-year basis and 13% on a 10-year basis. Looking to the next 3 years, Tyler is expected to deliver a 10% revenue CAGR and a 12% free cash flow CAGR, which is respectable, but again behind several peers, especially as valuation remains demanding, with Tyler trading at 45 times forward earnings and 34 times forward free cash flow, which is a premium to all peers. After doing a comparably and financial metrics comparison, Constellation Software actually might be the most intriguing, as it is expected to deliver higher forecasted growth and efficiency at a more reasonable multiple than Tyler. Next, we'll tackle 9 questions that outline Tyler's quality growth profile, which is a quantitative look at their predictability, profitability, and long-term value creation. Keep in mind this is mostly backward-looking to gauge historical quality, while the valuation section of this podcast layers in forward-looking factors. The first section, predictability, they get a 1 out of 2, with the first question being, is 5-year trailing revenue stability at least 0.84, which is my weighted portfolio average. And this is a revenue consistency metric that incorporates both trend and volatility. They do get a yes here at 0.091 as of the latest fiscal year. And where they slightly missed was the next question, which is 10-year SBC adjusted free cash flow linearity, at least 0.77, also my weighted portfolio average. And they just missed at 0.75. The next section, profitability, they get a 2 out of 2. They got a yes for is 10-year average gross margin at least 40%, as theirs was 46%. And then they also got a yes for SBC adjusted free cash flow margin at 16.8%, just clearing the 15% benchmark. And the third section, growth and free cash flow conversion, is 10-year revenue CAGR at least 5%, which is my minimum for long-term compounders. And there's definitely clear as this at 15.8%. And then I like to say is 10-year free cash flow per share CAGR at least double digits or 10%. And theirs is yes at 13.1%. And then to round out the section is 10-year median free cash flow conversion at least 75%. And theirs is yes again at 179%. On value creation, the last section of our quality growth profile here, they actually got a 0 out of 2. And the first question is 10-year combined average ROIC, at least 20%, and ideally greater than the industry average. For Tyler, I used my adjusted ROIC because GAAP-based ROIC is heavily distorted by large goodwill balances from their acquisitions. Anyway, on my adjusted basis, Tyler's 10-year median ROIC is 14.9%, which is below the 20% hurdle and also below the 26.9% software industry average. And then the second question is adjusted ROIC trending up if low or holding steady if already high? And for Tyler, no, adjusted ROIC has trended down from 18.6% in 2015 to 11.4% in 2024, although the recent increase from 2023 to 2024 is worth monitoring. We'll now dive into a high-level overview of Tyler's 3 financial statements. We'll first start with revenue per employee, which is relevant to Tyler's business models you'll see next. And this metric has steadily increased from $165,000 in 2015 to $304,000 trailing 12-month, compounding at around 6% annually. While this is far above the NYU software industry average of $65,000, it remains well below my sector top quartile benchmark of $891,000. Gross margins on an absolute basis are low for a software company, largely because their COGS is labor intensive. So think implementation teams, on-site services, and legacy product support. Still, margins have steadily compounded at around 0.8% per year over the last 20 years, with a historical ceiling around 47%. Operating margin has hovered between 15 to 20% over the last decade, while net profit margin has ranged from high single digits to 15% plus. The ongoing SaaS mix shift should provide structural tailwinds to gradually expand margins over time. COGS is consistently between 50 to 58% of revenue. The largest driver of COGS is personnel expense, and it's tied to software implementation, subscription delivery, and client support, alongside hosting costs for SaaS deployments, primarily via AWS. Continued SaaS migration and consolidation of on-premise versions should also reduce long-term support costs by redeploying resources towards development. For operating expenses, there's 3 main OpEx line items that consume around 70% of gross profits, and they're split between G&A, sales and marketing, and R&D. Sales and marketing is steadily at 17 to 18% of gross profit, while R&D typically runs 13 to 16%. G&A is the largest and most volatile bucket, and it's tied to salaries, SBC, and professional fees. Overall, S&M and R&D show consistency, while G&A swings more with compensation and corporate cost. Over the last 10 years, their interest coverage ratio has averaged 132 times, with a median of 74.7. This is well above Benjamin Grant's minimum threshold of 5 times and comfortably higher than my benchmark of 10. However, results have been volatile, with very strong pre-2020 coverage rates often above 150, but then they fell sharply in 2021 to 2022 to single digits as interest expenses spiked from M&A financing, and more recently in 2024 have rebounded to 55x, relative to the software industry median of 24.5x on Guru Focus. Tyler looks strong again. Turning over the balance sheet, their assets are dominated by goodwill, cash, and accounts receivable. Over the last decade, cash and equivalents have averaged around 9% of total assets, with a recent rebound to 15% in 2024. Accounts receivable has been steady at around 15% of assets, and the standout item here is goodwill, which surged after acquisitions like NIC in 2021 and has held near 48 to 54% of assets since. This still exceeds my 30% threshold and the NYU database software average of 30.3%, underscoring the acquisition-heavy growth model. Their liability structure is dominated by deferred revenue, which has historically made up over 60% of liabilities, but now accounts for around 40%. This reflects that subscription and multi-year contract model where cash is collected up front, but recognized over time. Accrued liabilities, which is mostly payroll, benefits, and operating costs, average around 12% of liabilities and are steady. Accounts payable is minor but rising, reaching 9% of liabilities in 2024. The biggest swing factor here is long-term debt. It was near zero until the NIC acquisition in 2021, and that drove leverage above 50% of total liabilities before declining to around 33% in 2024. Overall, their balance sheet shows a predictable subscription-driven liability base, but with that debt overhang that remains material compared to its pre-2021 history. There's 3 financial stability ratios that we look at. The first, debt to equity. Tyler's leverage remains very conservative with a 10-year median of 0.14 versus a software industry median of 0.20 and well below my 1.50 threshold. It did spike to 0.60 post-NIC acquisition in 2021, but has declined steadily since. The cash to debt ratio has been a little bit more volatile over the past decade, swinging from extremely high levels like 31x in 2020 to weak coverage around 0.2 to 3x in 2021 and 2022. The latest quarter shows a ratio of 1.4x, comfortably above that 0.75 benchmark that I use, but still below the software industry median of 2.5. For debt to free cash flow, this ratio tracks how many years of free cash flow would be required to pay off debt. Their 10-year median sits at 0.8x, which is well under the safe 3 threshold that we employ here. And the company did hit a stress level in 2021 at 4x, but quickly improved. And as of Q2 25, leverage is around 1x, which is still within safe bounds. Lastly, my favorite statement, the cash flow statement. Looking at cash flow from operations, they generated $625 million in operating cash flow in 2024, which was a sharp increase from $380 million in 2023. The main inflows were net income, D&A, and SBC, plus a strong working capital boost from deferred revenue and receivables. Overall, their operating cash flow strength reflects their SaaS shift with subscription billings and deferred revenue as major cash generators. We then like to look at their free cash flow conversion, their SBC intensity, and their capital intensity. And probably not surprisingly, they have high free cash flow conversion. Their 10-year median is 179%, which exceeds my 75% threshold. Their SBC intensity I rate as medium, as their 10-year median as a percentage of revenue is 5.6%, which is comfortably below my 10% threshold and the industry average of 8.1%. However, if you look at SBC as a percentage of operating cash flow, it is higher with a 10-year median of 20% versus my portfolio weighted average of 9%. And then looking at their capital intensity, I have this as low. Their 10-year median CapEx is 2.1% of revenue and has been trending down. This is well below the industry average and my portfolio weighted average, which indicates a very asset-light model with minimal reinvestment needs, freeing cash flow up for other things. Now, let's talk about who's actually steering the ship at Tyler and whether their incentives line up with long-term shareholders. As we know on this podcast, I like to start by doing a classification system for all CEOs, and this ranges from most to least knowledgeable and passionate about the business. I classify Tyler CEO Lynn Moore Jr. as a long-tenured manager, as he has been with Tyler since 1997 and became CEO in 2018, which gives him over 25 years at the company and almost 9 years as CEO, which does exceed the US average tenure of 4.8 years. I then like to look at employee sentiment on Glassdoor, and they score pretty well here. Their recommend to a friend or NPS rating is 74%, and this is in 1,000 plus reviews. It's also above my database median of 72% and slightly below the 80% top quartile cutoff. Their CEO approval rating is 84%, and 75% have a positive business outlook. So overall, pretty good on Glassdoor. Let's now learn a little bit more about how they're paid, and this is more important if insider ownership is low, as it is with Tyler. First, their compensation structure. Their CEO, Lynn Moore Jr., received around $8.9 million in 2024 compensation, with 8% base salary and 92% at-risk variable pay, which includes PSUs, RSUs, and short-term stock incentives. He owns around 0.2% of shares outstanding. The majority of his comp is equity-linked, with long-term PSUs tied to performance and recurring revenue growth and operating margin specifically. His $8.9 million package is below average for companies of similar size in the US. The median is $13.5 million, and this is according to Simply Wall Street. So that does suggest that he is not at least overpaid relative to peers. I then like to look at what KPIs they're using for compensation. And incentives here are based on non-GAAP EPS in the short term and 3-year recurring revenue growth plus operating margin in the long term. The use of adjusted EPS is a slight negative, but the strong weighting toward recurring revenue growth and operating margin, which are more core business drivers, is a positive alignment with shareholders. Overall, compensation is structured well, heavily performance-based and equity-linked, with a relatively modest fixed salary. CEO ownership percentage is small, which makes these equity incentives important to align management with shareholders. Then I'd like to turn my attention to capital allocation, and we do have a Morningstar rating for Tyler. They assign them a standard capital allocation rating, and I do agree with that assessment. The company maintains a sound balance sheet. The company has consistently prioritized reinvestment into organic growth and strategic M&A over shareholder distributions through buybacks or dividends. And they note in one of their investor decks that M&A typically is around 40% of free cash flow. So within capital allocation, we also like to look at just the trend in shares outstanding, and then also our shareholder distribution metric, which is buybacks plus dividends as a percentage of free cash flow. Now, over the past decade, their median shareholder distribution is just 4%, which is well below my 100% threshold. And while repurchases have been uneven, free cash flow has remained consistently positive, giving them ample flexibility. They do not pay a dividend. And as we mentioned just a second ago, it's not surprising that this distribution metric is low given their capital allocation priorities. Looking at diluted shares outstanding, they have actually risen 27% over the last 10 years, which reflects SBC and acquisition-related issuance. This dilution is a negative, though the rate has slowed in recent years. It's actually flat over the past year and up just 2.4% over the last 3 years. I then like to look at deal making if it's relevant, and this includes their acquisition strategy and reliance, and it definitely is for Tyler. Now, with their acquisition strategy, Tyler mostly acquires 2 to 3 small acquisitions a year, with the largest deal NIC in 2021 for $2.3 billion, and this added payments platform processing capabilities to Tyler. And while the integration did require upfront investment, results have shown progress. They mentioned that NIC revenues grew 13% in 2022, with transaction-based revenue still contributing the next 2 years. And then in 2025, they've positioned NIC as central to their connected community strategy, though its standalone impact is harder now to isolate. And then quantitatively looking at acquisitions, I like to look at acquisition intensity, which is acquisitions as a percentage of operating cash flow. Tyler's 10-year median is 30%, which does actually put it in the high reliance category. The clear outlier, of course, was that 2021 acquisition we just talked about, which spiked intensity to 562% of operating cash flow that year. Since then, activity has normalized with a 3-year median of just 20%, indicating a more selective tuck-in strategy. Then to round out this section, I like to do an alignment check, and that looks at insider ownership and institutional ownership, insider trading trends, and then if management has any long-term goals. For insider ownership, they are well below my benchmark, which is 10%. Simply Wall Street has them as less than 1%, and Guru Focus has them close to 3% insider ownership. For institutional ownership, my benchmark is 75%. And they definitely meet that criteria on both Simply Wall Street and Guru Focus at 98% and 97% respectively. Over the past 3 months, insider activity has leaned negative with more shares sold than bought. And then on a 12-month basis, that trend also holds with insiders selling roughly twice as many as they purchased. Okay, let's talk a little bit about long-term goals and credibility from management. So by 2030, they're aiming for revenues of $3.6 to $3.8 billion, which implies a 9.5% CAGR. They want recurring revenue over 90%. I think it's around 86% today. They have operating margin above 30%, which would actually be double the trailing 12-month Q2 25 of 16%. and then free cash flow margins in the high 20s. So all of the above seems mostly challenging yet achievable, except I think operating margin is a potential stretch goal here. Let's now dive into a few key metrics that are critical to monitor for Tyler Technology. First, subscription share of recurring. This KPI measures the quality of their revenue base as it shifts away from maintenance and one-time services towards true SaaS subscriptions. Over the last 4 years, SaaS recurring percentage has climbed from 43% in 2020 to more than 75% in 2024, which is around a 14% CAGR. Why this matters? Well, higher SaaS mix is more predictable cash flows, stronger margins, and potentially a higher multiple justification. I would then track adjusted ROIC, which you'll see on X for my full tweet and equation. But reported ROIC for Tyler is distorted by goodwill and acquisition accounting. Tracking this adjusted ROIC helps you cut through accounting noise and benchmark Tyler more accurately against itself and peers. Also, the final 2025 percentage here in a few months will tell us if that 2023 to 2024 upward trend was real. Just one runner-up KPI too I wanted to mention is backlog coverage. This is backlog to be recognized in the next 12 months divided by total revenues, and it tracks how much near-term revenue is already contractually secured. For Tyler, this ratio has declined from 1.42x in 2020 to 0.95x in 2024, with a median of 1.04x. So the trend suggests that Tyler's leaning more on new sales rather than backlog to sustain growth, but monitoring this metric will be key for assessing that revenue visibility. Let's wrap with valuation and technicals. For valuation, I use a hybrid approach. Multiples give me a snapshot of market sentiment, while intrinsic valuation methods like DCF act as my long-term compass. Given Tyler's current business lifecycle stage and mature growth and solid free cash flow stability range in that 0.60 to 0.70 range, cash flow and mid-cycle earnings multiples valuation methods are relevant for assessing fair value. Looking at a DCF, I used Investors Grow, and using 37 analyst free cash flow estimates, the model assumes a 9% discount rate, a 2.5% perpetual growth rate, and 4 years of analyst projections, followed by another 6 years of gradually declining growth rather than dropping straight to that 2.5%. And note, I do have them at around $1 billion in free cash flow by 2030, which their own investor decks have as targets too. So based on all that, their fair value comes out to $320 per share, which is about 38% below the current price of $520. That implies a forward IRR of roughly 7%. Then looking at a reverse DCF using my own spreadsheet, this flips the script and it tells us what growth rate today's $520 price has baked in. If you plug in a 20 times perpetual price to free cash flow multiple, you get an implied around 14% annual free cash flow per share growth over the next decade. Based on their 10-year average of 13%, 5-year average of 21%, and 3-year average of 20%, I do think this is achievable, but it's also not a low hurdle. Looking next at an SBC adjusted free cash flow yield using stock analysis and Investors Grow, this metric ties their valuation to cash generation, excluding their very low SBC. Their trailing 12-month Q2 25 adjusted free cash flow yield is 2.18%, with 2026 forward at 2.48%, if you assume around $726 million in free cash flow and around $172 million in SBC. These yields are above the 3, 5, and 10-year medians, although not necessarily high from an absolute perspective. The 10-year treasury rate is 4.18%. And then from a multiple perspective, I actually looked at EV to EBIT plus R&D, which we also use for the trade desk, and this is my own spreadsheet. It's useful for companies like Tyler as well that reinvest consistently into R&D, and it treats R&D as a long-term investment instead of that near-term expense. So Tyler's trailing 12-month Q2 25 multiple of 42.5x is below its 5 and 10-year medians of 55.6 and 46.7. And if it returns to its 10-year median, then that implies a stock price of $561, which is actually above today's price. It's worth noting that post-pandemic, its multiple has also been consistently higher than Workday's and Oracle's. Oracle's trailing 12-month multiple now sits at 32.6x, and Workday's is 17.6x. Overall, Tyler screens expensive versus intrinsic value. DCF has them around $320, but the market is pricing in around 14% free cash flow growth, which is aggressive but not unprecedented given its history. And cash flow yields remain thin, absolutely, but not necessarily relative to their history, while mid-cycle multiples suggest the stock isn't wildly out of line with its own history, despite still being expensive versus peers. Before we get to the verdict, let's briefly talk some technical analysis, which I like to use for determining entry points or exit points of a stock. On the 1-year charts, I'm using a linear scale and daily data, and for the 5-year charts, I'm using a logarithmic scale and weekly data. So on the daily 1-year linear scale, the current price of $520 is below all key EMAs, and I'm looking at the 20, 50, 100, and 200, which is showing a short-term downtrend. The slope of the shorter EMAs, the 20 and 50, is downward, reinforcing that bearish momentum. Looking at the weekly 5-year log scale chart, the current price is above the 200-week EMA at $476, which is keeping that long-term trend intact. However, it is below the 20, 50, and 100-week EMAs, showing intermediate weakness. Based on my stage framework, Tyler screens as both a stage 3 and stage 4. On the 1-year chart, it is already in a stage 4 downtrend, while the 5-year chart indicates more stage 3 topping phase. Looking at some volume analysis, on the 1-year chart, the heaviest volume sits between $540 and $565, creating strong resistance. Support below current levels doesn't show up until around $500. On the 5-year log view, the key demand zone is $450 to $480 near the 200-week EMA, making it the strongest long-term support and potential entry point. Also, short-term interest for Tyler is low. It stands at 2.8% afloat, which is 1.2 million shares, and that's classified as low by market standards, which is usually less than 5% afloat, and it also declined 4.7% versus last month. All right, now let's get to the verdict. Here's the investor's dilemma that I see with Tyler. Bulls see them as a high-quality, pure play on government software with strong SaaS and payment tailwinds, while bears point to steep valuation, competitive pressure, and uncertainty around the NIC acquisition impact. For a TSR or total shareholder return forecast, I'm projecting a base case 5-year return of 8.1% per year, and the full sensitivity matrix is posted to X if anyone wants to take a look at that. But the base case breakdown is a 2.78% starting free cash flow yield and 8.90% free cash flow per share growth. This is custom calculations off analyst estimates to get to $948 million in 2029 free cash flow with 44 million diluted shares outstanding using a negative 0.5% buyback yield. And then I also have them with a negative valuation multiple impact at minus 3.58%, going from a 36 to 30 price to free cash flow multiple. Tyler scores only 53% on my quality score, though its quality growth profile at 6 out of 9 is much stronger despite being held back by lower ROIC. Valuation models imply a fair value between 320 at the low end and 560 at the high end, and its stock is trading above 5-year support levels, but on a 1-year downtrend. While management's 2030 roadmap is compelling, bottom line, Tyler stays on my watch list. I like the business, runway, and pure play positioning, similar to BMI and smart water meters, but I want a margin of safety given the valuation and competitive risk. I'd be eyeing an entry in the 450 to 480 demand zone, where technical support aligns better with fundamentals. And that wraps up today's episode of Stock Spotlight. I hope you found my analysis of Tyler Technologies both insightful and actionable. If you enjoyed today's episode, drop a comment or take the episode poll. For real-time updates, follow me on X at invest091. Join me next when we'll do 2 interesting deep dives, one a Q&A on Copart, and then I'll be diving into Cintas Corporation. Until then, keep your investments smart.